with the growing awareness about financial independence, women have been able to manage their own finances and attain financial stability. However, the road still seems challenging. India is the sixth biggest equity market globally, and it ranks in the bottom quartile when it comes to female participation in the stock markets. As per a report shared by Mint recently, only 7% of women in India invest independently through self-learning. Overall, 55% women in the country are either not investing or are unaware of their investments. Be it homemakers or working women, stepping into the financial sphere might seem challenging at first, but by employing effective research and constructive strategies, they can surely give a kickstart to their money management journey. So let's begin with this interactive session with a very honorable guest and speaker for the evening, whom I would like to introduce you to all. Amrita Mohanty, Associate Director and Head Learning and Development for WhiteOak Capital Mutual Fund. It is great to have an industry expert, and she has conducted numerous training programs across the country, conceptualized and devised workshops and sessions. She has written over 200 articles which focus on demystifying financial market terminologies and jargons. Her expertise lies in the domains of mutual fund investment concepts, macroeconomics, behavioral economics, financial markets, asset classes, retirement planning, taxation, cryptocurrency, and practice management. We are super excited to have you as a guest speaker on the occasion of International Women's Day 2023, Amrita. Thanks for taking out the time.
Thank you so much, Palka, for the wonderful introduction. I really appreciate it, and thanks a lot for inviting me for the session.
It's our pleasure, really. Okay, now one request to the audience. You all may feel free to drop your questions on the topics that we are discussing today, or you can even share your experiences in the chat box on your screens. The session moderator will collect the questions and we can answer them for you at the end of the talk. Also, we have a very special gift for our audience today. We have a few soft copies of the book Psychology of Money to give away. So whoever we find is interacting and engaging with us quite a lot during this webinar gets to keep one such copy. So Amrita, thank you once again for joining us today. If I could start this interaction by asking you about what do you think about this year's International Women's Day theme of embracing equity, and how can we relate this to money management?
It's a very profound theme, Palka, and thank you so much for asking me such an interesting question. So you pointed out certain startling statistics that in terms of women's participation in money management, or in terms of their representation in workforce. While the skill levels of women has gone up, the educational qualifications of women have gone up, but a lot could be done in terms of, promoting them in the workforce, or in terms of equal pay parity. And also women can also do wonders when it comes to managing their finances. So time and again, reports and studies have shown that women are capable savers. In fact, they indulge in less trading, and women essentially have a very long-term perspective, a mature and evolved perspective when it comes to money management. However, a lot of these research and studies have indicated that their confidence level is slightly on the lower side. So when we speak about inculcating equity, now equity is different than equality, because equity means that it's very adaptable and flexible to one's circumstances. For example, if we have two children and we want to give them a certain food item, not necessarily that both of them would like the same food. We might have to give apples to one and bananas to other. So that's what is equity. And it's a very evolved theme, which means that women are, as I've said, capable savers, but their knowledge levels or their confidence, especially when it comes to taking money management decisions, could be differing or different. Therefore, I think as women collectively, we should organize a lot such sessions. And I appreciate the fact that Mastertrust has organized the sessions where we conduct personalized training programs, awareness sessions, so that we hone that skill, the saving skill of women, into an investing and far more evolved investment capabilities and caliber.
That is so very beautifully put. I couldn't have explained it better. Another question, and I'm sure a lot of people
Sure.
in the audience and me myself, would love to hear about, is how did you start with your investment journey personally, and did you depend on a lot of people for your financial decisions? And what has changed for you over the years as far as taking care of your money is concerned?
I think that's a great question, Palka. In fact, I started my career way back in 2002. And those were the glorious years for the Indian economy and for the Indian financial markets. That was called the India shining phase. And it was great to be employed, doing well in my career, but I never took investing and saving very seriously. In fact, I felt that good things will last forever. And I was so happy and excited buying gifts for my parents, for my siblings, and splurging all my money around with the newfound financial independence that I got by working in multiple reputed organizations. But my reality check happened during the global financial crisis of 2008. That was my first encounter with bear markets, with recession. And that was a very painful bear market era because what happened in the United States in the format of subprime price crisis actually spread its tentacles worldwide. And we saw Nifty and Sensex correcting by almost 60%. And markets were in a lackluster mode for almost 14 to 20 months. And one was to witness such kind of a recessionary impact. There were job stagnancy, pay cuts, etc. And even as a finance professional, it was so difficult to convince investors and intermediaries that they should allocate money into equity asset class, because as per the famous adages that buy low, sell high, buy when everybody is selling, sell when everybody is buying, etc., those adages were not implemented in practicality and actuality. And that's when I went to my line manager at that point in time, and I lamented that I'm struggling to convince people to invest into equity asset class. And one words of wisdom that he gave me at that juncture is, have you invested? Do you have your own account statements as testimonials to show to your investors that I'm with you in this journey? My investments are also there, and I fully believe that there is a recovery possible. And equity investing, particularly, is for the long term. And honestly, I had a very minuscule, trivial SIP investments. So, but that comment really struck to me, and I felt it was quite a valuable advice that was given. And a lot of my investments and a lot of my SIPs especially happened at that juncture. So when I look back, I actually invested at a time when there was a despondency. It was not a phase of euphoria. And I actually did a contrarian investing, but more than that, beyond markets, it's not in my control. What's in my control is saving a lot more. So I actually became a prudent saver and investor at that era. And I think I'm reaping the fruits today.
That's amazing. That answer of yours had all the gems of, how to start investing, what to do, what exactly, are the key principles to follow. So really looking forward to this talk. The floor is all yours, Amrita, if you can share your screen now.
Sure, I will, Palka. Palka, is my screen visible?
Yes, absolutely.
Sure. So I will begin at this juncture. So thank you so much, Palka, and the team of mastertrust for inviting WhiteOak and me for having a discussion on financial independence of women in this in the Women's Day week or in the Women's Day year. Now, as Palka had mentioned, we intend to make this presentation or this session far more interactive. So the entire program is interspersed with lots of trivias, impromptu questions, knowledge checks, etc. So please feel free to participate, chip in your answers using the chat box. So what's essentially that we are going to cover is obviously differentiating between, there's one thing about getting wealthy. The other aspect is staying wealthy, sustaining your wealth. And we are going to ideate and debate on that. We're going to look at a savings formula. And when it comes to budgeting and money management, there are these certain heuristics or rule of thumb or thumb rules. Well, they are thumb rules, but they can actually guide you in some way or the other, especially the 50-30-20 rule and the 3-6-9 rule of emergency corpus building has helped me on a personal level. And I felt that I should share that with this August audience. Whenever you're evaluating different investment options and solutions, you have to ask yourself, are we getting a simple rate of interest or are we getting a compound rate of interest? So we will ideate on that. We will look into the formula of compound interest because it has a treasure trove of learning. And what's the learning is the more you save makes a difference. The kind of return you earn, and especially if that return is inflation adjusted, it can make a massive impact. Why investment should be linked to financial goals. The power of now, like, if we go back to Kabir Das's, Sant Kabir's saying that Kal kare so aaj kare so ab, pal mein parle hoegi, bahuri karega kab. So the power of now, why we should not be procrastinating it. A sense of SIP, so a certain Section 80C products. And if you are into the old tax regime, this can come in handy, etc. is what we will be looking at. We will end with the resilience and the power of Indian women. And they have risen, they have run against the tide, and they have created a medal for themselves, but that can be also replicated when it comes to the financial world. So with that in mind, let me, speak about this legendary stock market trader. And his name was Jesse Livermore. Now, he was considered to be an icon when it came to trading, in the sense that I'm sure all of you would have heard about the Great Depression of 1929. So there was this massive stock market crash, recession in the US, and I believe Dow Jones, which is one of their primary indices, actually crashed by 89% over that time frame of 1929 to probably 1935. And when markets were totally bleeding, this gentleman actually made a lot of profits because he shorted the markets. He sold a lot of shares and he made profits to the tune of $3 billion. Well, that's quite a lot of money. Now, despite of all that, there's something sad and sordid that has happened with him. And the reason is that fast forward 4 years later, he was overconfident. He made larger and larger bets. He had increasing number of debts. He had taken a lot of margin trade calls, etc., which eventually the outcome was not conducive to him. He became bankrupt and it had a sordid end. He had to ultimately take his life. Now, the newspapers then detailed a lot about his scandals and his personal mishap rather than the achievement of the earlier days. Now, why am I sharing this story and this sad anecdote is that there is a difference. We can get wealthy. We can be into high-flying jobs, high-paying jobs. We can get a lot of success in our business and practice. But getting wealthy is one thing, but staying wealthy, making sure that the wealth sustains for a long period of time is the main area that we have to ponder. That our skill sets have made us reach to a certain level, but how do we ensure that that certain amount of wealth that we have created gets sustained for the long term?
So a quick question here, Amrita.
Sure.
With so many people, traders and investors joining the market since 2020, especially, since the pandemic started,
right.
What are the mistakes that you have seen happening often in the market, and how do you think we can avoid them?
I think that's a fantastic and relevant question, Palka, is that we saw demat accounts soaring after the onset of COVID-19. So COVID-19 was a period where between February and March, we saw markets correcting by almost 39%. And then there was a sharp recovery, and welcome 2021, there was a spate of IPOs that were launched. And a lot of retail investors in fact, blindly invested into a lot of these IPOs. We saw a surge of demat accounts. We also saw craze for cryptocurrencies. So forget about stock markets. We actually saw a lot of investors, getting into meme coins and the crypto, coins of the world. Now, one learning is that whenever you are investing, we should avoid investing basis hearsays and rumors and being susceptible to FOMO mentality. So I'm sure you all of us know what is FOMO. If you want to, expand the same, please use the chat box and let us know. So FOMO is fear of missing out. And a lot of people felt that, equity markets have appreciated, markets have recovered. I hope we are not missing the buzz. We hear everywhere in business television that this IPO and that IPO is coming, and we should not miss the fervor. And a lot of investments happened rather not basis on fundamental research and analysis, but basis hearsays and basis rumors and basis the fear that we will miss out the excitement. So one learning is that investment should not be based on extraneous factors. Whenever you are investing, it is as intrinsic and as personal to you. We have to understand that what are the future expenses that can arise. We have to appreciate the fact that every financial instrument has some pros to it, has some flip sides to it. So if we take a very balanced perspective, red team with probably a colleague or with a well-wisher, or read a lot of books and blogs and articles, so that we create a balanced perspective about events, so that we don't get driven into that flood of a particular thinking, which is called the herd mentality, blindly following the crowd. If we can refrain from blindly following the crowd, which is herd mentality, or even getting overtly panicked when there is a massive fall, and not liking too much of reds and negative returns in our portfolio, which is fair enough as a human being to be a bit perturbed. But getting excessive reaction either to a profit or to a loss is one of the follies and fallacies of human beings. So it's very important to introspect, get a balanced perspective. In fact, team up with somebody who's wise to take their opinion, and then take a balanced call, which is based on your risk appetite, your financial goals, and your time frame.
Sounds good. Thank you for that.
Sure. Thank you so much, Palka. So there are a million ways, as I've said, to get wealthy. We could buy our dream stocks and become wealthy. We could float a business and become wealthy. We can do really well in our company and get a lot of promotions and become wealthy. But when it comes to staying wealthy, there are only two, or if not two, maybe very few ways required. And the way is frugality. Well, we are human beings. We want to splurge on ourselves, on our family members, on our loved ones. But as you know, if you are into spirituality of any religion and faith, one thing that's always taught is that you have to be moderate and you have to practice the path of non-excessiveness. So similarly, when it comes to creating wealth, it's not being excessively stingy, but it's important to be frugal. It's important to be moderate and non-excessive, which is cutting down on unnecessary expenses. And it's important to, the only thing, we cannot control recessions. We cannot control the Russia-Ukraine war. We cannot control a lot of events around us. But what we can control is ourselves. Are we enhancing our knowledge, our skill sets? Is our mental health in the right way? How can we, live a spiritually, mentally, health-wise, a good, fuller life? And these are the things in our control. Similarly, saving regularly and investing not sporadically, but investing regularly and for the long term are the ways to create wealth. So let me ask you a question, and I would like to throw a trivia to our honorable gathering. That who do you think is the most successful investors within the two choices that we have given you? Was Jim Simons a very successful investor, or was Warren Buffett a very successful investor?
It'll be great if we can use the chat box to answer this quickly. Jim Simons or Warren Buffett?
So I'm getting a lot of response. Warren Buffett, Rohit says Warren Buffett, Shivali says Warren Buffett. I'm sorry if I've missed out on few names. Arvinder has said Warren Buffett. Uma's answer is Jim Simons. So the chat box is getting flooded with lots of responses, and we deeply appreciate your interactivity. So there is a lot of votes for Warren Buffett, but the reality is that it was Jim Simons when it comes to creating those extra returns. It was Jim Simons who was a more successful investor. Now, who's this gentleman called Jim Simons? He was head of a hedge fund called Renaissance Technology, and his portfolio actually created a return which was compounding in nature to the tune of 66% per annum. Compare that with Mr. Warren Buffett, his wealth compounded by 22% per annum. So when it comes to success in terms of pure returns, Jim Simons, it seems to be a far successful investor. Successful is one thing, being richer is another thing. So even if Jim Simons' portfolio returns were great, but then his overall net worth was $21 billion. And as per the book called Psychology of Money, whenever it was published, Warren Buffett's net worth was almost $85 billion. How is it that one investor is able to generate 66% compounded returns compared to Warren Buffett, whose compounded returns are far lesser, but Warren ends up having so much of wealth creation compared to Jim Simons? Any idea how is it that we saw Jim Simon creating a lot of returns, but it's not translating or permeating into wealth? How is it possible? Any idea, any clue? Please feel free to chip in your response using the chat box. Why is this anomaly? Why is this difference? What do you think could be the what do you think are the reasons that could have contributed to such kind of an anomaly? So Vinay says compound effect, interesting. I think, yes, that is one of the reasons. Reinvestment, Jim Simons could not sustain, is the response we're getting from Rupa. Tushar mentions that it could be compounding. Well, yes, it is the magic of compounding. It is also related to the fact that he started investing at the age of 10. And Jim Simons found his mojo, his investing stride, when he was 50. So from 50 to 70, a 66% compounded return, well, that was stupendous performance, could lead to certain wealth creation. But if somebody starts investing at a very young age and has invested not just for 2 decades, but multiple decades, right? 50, 60, 70 years, you can understand that obviously that has led to better net worth. So as I've said, Jim Simons' investment stride was until he was 50 years, and Warren Buffett's serious investing started when he was just a small child. And in fact, he may not be the most successful investor, but he's obviously the most disciplined, and that actually permeated into creating a lot of wealth, because literally 99.6% of his wealth came after his 50th birthday. So what is very important is that we feel that the income that we get, we have those expenses, we need to take care of that expenses. So income minus expense is what should we get into our saving avenue. But that's not the right way to save. In fact, there is a famous quote that do not save what is left after spending, but spend what is left after saving, by saying Warren Buffett, which means that whenever you get a certain income, look at how much you can save out of it. And income minus savings, the leftover gap is what should go towards expenses. It can be a little overwhelming for a lot of us that, no, we have a lot of expenses. How can we cut it down? But if you make a certain decision that, no, the moment I get my income, a certain proportion of it has to go towards saving, our mind will automatically get attuned to, adjusting our expenses and our needs and our wants accordingly. So, how do we save? What percentage do we save? There is this thumb rule. This is a thumb rule. This is not an exact science to the way or path of saving, but it's a good enough starting point. So you would have heard about this rule called 50-30-20 rule of budgeting. Now, obviously, these are percentages, 50%, 30%, 20%. A quick trivia. They basically correspond to needs, wants, and savings. So if I have to ask all of you that what percentage will go towards needs, what percentage goes towards is associated towards wants, and what percentage should be what is channelized towards savings, what would be your response? So it's a percentage rule, which is demarcating your money into needs, wants, and savings. So what percentage can be associated towards needs, towards wants, towards savings? You may want to use the chat box and give your answer. So Kusum, you have mentioned 30. So 30 stands for what? Does it stand for saving, or does it stand for expenses that cannot be avoided, which is needs, or does it stand for wants? So Tushar says that 50% goes towards needs, 30% goes towards saving, 20% goes towards wants. I think that's a fantastic contribution. Thank you so much for that, Tushar. However, if at all we find it difficult to save 30% of our income towards different saving channels and avenues, we should actually start with at least 20%. Now let me again decode what is 50-30-20 rule. So there are certain expenses that are unavoidable, taking care of our utility bills, transportation expense, school fees, etc. So these are the needs. These are basic expenses, necessary expenses, unavoidable expenses. So assume we get an income of 100 rupees. 50 rupees obviously goes towards those need-based expenses, which are necessary and unavoidable. We are social beings. We are emotional. We have our emotional needs as well. So maybe 30% goes towards your wants. It could be, shopping, entertainment, taking a vacation, buying something for yourself, visiting restaurants, etc. But the thumb rule says that 20% of your of your income should be saved. It should be saved for rainier days. It should be saved for unforeseen events in future, which means that if we have an income of 100 rupees, at least 20 rupees of that, at least 20% of that should be saved. So let's quickly do a case study. Imagine that there is an employee who's working in a leading Indian company, earns 1 lakh rupees a month after tax, and her expenses are as follows. She pays a home loan EMI of 30,000, grocery bills are 10,000, utility bills are 6,000. She's got a transportation expense of 4,000. A restaurant bills amount to 10,000 rupees a month. These are all monthly breakup of expenses. She's got a shopping expenses of 30,000 rupees a month. And she does a monthly systematic investment plan, which is like a monthly recurring saving plan into a mutual fund scheme to the tune of 10,000. So I like to ask all of you, if you have to apply the 50-30-20 rule, where 50% is expenses going towards the necessary ones, 30% is expenses going towards your wishes and your wants and your desires, and 20% goes towards saving. Is this employee, or is she saving enough? Would you say, is she saving enough? A quick yes or a no. So getting a lot of responses. Thank you, Nikita. Thank you, Simran. Thank you, Priyanka. Thank you, Aarti, for your response. A lot of us are cohesively, vehemently saying that it's a no, and no it is. Because if we have to bucketize all her expenses into 3 compartments or 3 buckets, needs. So obviously 50% of her salary goes towards paying the home loan EMI, the grocery, utility, transportation expenses, etc. She's spending 40% of her income towards the wants, which is shopping and restaurant. And she's got, 10% going towards a monthly saving mode. Well, she's saving something, but can she look at pruning down her wants? Can her shopping expenses come down a bit? Can her restaurant bills come down a bit? So there are a lot of things that she can do for releasing funds that could be actually saved, and that can actually help her shield herself, safeguard herself for the future exigencies and situations that may arise. So obviously she can save a bit more, so she's not saving enough. So again, the moral of the story is that building wealth has got little to do with your income or returns. As I've said, a lot to do not with your rate of returns that you're earning on, which is important, but a lot to do with the amount of savings that you can contribute.
Thanks for that, Amrita.
Sure.
Just a quick question here to bring the discussion back to women a little bit.
Yeah.
In your experience, and you had mentioned this earlier too, in your experience, do you think women save and invest differently than men?
So women are far more cautious investors. They are, as I've said, that they don't churn their portfolio a lot more. They don't indulge into trading. In fact, they are prudent risk takers, very good at saving. But where the lacuna or the gap lies is in terms of starting to take the investment decision early on in life. Like there was a study done by Kuvera, which actually says that the median age for women when it comes to taking savings and investment decision is around 33. As against men who start saving as early or start investing as early as 25 years of age. So why is it that women are equally qualified, but they're starting so late? The other aspect that has come out is that they're not very confident about their savings decision. So it could be also, driving the fact that women face a lot of unconscious bias at workplace. They sacrifice a lot to take care of their family, etc. So they are a little bit more conservative. Those are the trends and patterns that have come. But the positive side is that women are far more sensible savers. It is just about amping up your game, regaining that confidence, and rather than fretting and being anxious and worried about what will happen into the future, that is what a few of us women are gullible to. We should be very strong, strong-headed or bull-headed, and start investing at an earlier age and start objectively looking at different returns, and rather than being skewed only to fixed deposits or bonds or post office savings.
So all the women and girls out there in the audience, I think it's important to take Amrita's advice today and start researching about, what assets you want to invest in. It's a very wise decision to take your finances seriously from today.
Sure.
Thanks,
you so much. Thank you so much, Palka. So, life is full of surprises. You would have heard this quote that change is the only constant factor. And COVID, like if I have to share a personal example of mine, Palka, is that my entire family got struck with COVID and we were all hospitalized. All of us were hospitalized. And at that point in time, when the calamity struck, I don't think COVID was even a part of medical insurance. So I literally had to break my savings at that point in time to take care of the medical expenses, hospitalization expenses. And they were not, by the way, cheap. It was quite exorbitant because we were the first victims of COVID, the first wave of COVID. But thankfully, all that savings and my emergency fund and the fact that I could liquidate it, having one drip, one hand having a drip and being hospitalized, and yet with my mobile phone app being able to liquidate it, gave me a lot of confidence that I had saved for unforeseen situations and unforeseen circumstances. So please create a solid emergency fund. It's very important in life to have a barbell approach. Very important to be optimistic about life, that everything is going to go great. It's good to have optimism, but the optimism has to be measured, because always have room for error. It's not important to be rational, but it's very important to be reasonable. We should be alert for what kind of flip sides and downsides we might encounter, and accordingly, therefore, it's important that you should build an emergency corpus as well. Again, this is a thumb rule. It is not a extremely articulated or precise rule, but these are just ballpark numbers that will help you to guide that what should be my emergency corpus. So if you're single, with you have to pay a rent instead of owning a home, so at least look at saving 3 months of your current income or living expenses into an emergency fund. So if your expenses are, say, 20,000 rupees a month, then 20,000 into 3, 60,000 rupees goes towards building that emergency corpus. If you have a family, you've got dependent family members, you've got a mortgage, so 6 months at least your emergency corpus. Ideally, it should be for 1 year or 12 months, but at least it should be it should be worth 6 months of your income or your living expenses. And if you are a freelancer, business owner, your emergency fund should be at least 9 months of your living expenses or income. So let me ask you a question. Are you saving smartly? And the question is, which 10% rate of return is better than which 10%? So would you want to invest into a bond instrument that pays 10% simple interest for 5 years? Or would you want to invest into a bond fund that actually generates 10% compounded interest for 5 years? Which would be your choice? Would you go for option 1 or would you be going for option 2? So a lot of us are giving the response option 2. Thank you so much, Ashok, Aarti, Ratna. I really appreciate your responses. And option 2 it is. And the reason is, look at this, in simple interest, you get an interest on the principal amount. Now, the interest that we get on a lakh of rupees investment at 10% rate of simple interest is a 10,000 rupees interest. Now, this 10,000 is not getting added to the original principal amount, and you're not getting an interest of 10% on principal plus interest. It's simple interest paid out on the original principal amount, which means 10% of 1 lakh, you get a 10,000 interest amount payment in the first year. Again, in the next year, it's 10% multiplied by 1 lakh, which is another 10,000, so on and so forth. Your total principal amount paid is 50,000 in 5 years. So the formula of simple interest is actually FV equals to PV multiplied by 1 plus N into R. Now, we don't have to mug up the formula, but what does it mean? FV stands for future value, PV stands for present value, which is the amount that you have invested. N stands for the number of years and R stands for the rate of return. So you can see that N is adjacent to R. That means that it is a very linear format of wealth creation. It is not an exponential format of wealth creation. When you plug in all the values, which is 1 lakh multiplied by 1 plus 5 into 10%, the overall value of our investment is, well, we get our 1 lakh rupees back and we have made 50,000 worth of interest. So our wealth creation is that 1 lakh has become 1 lakh 50,000. Now let's take the case of compound interest. As I've said, in compound interest, the first year we get a 10% on 1 lakh. So we get a 10,000 interest amount. But something different happens, which actually leads to the magic of wealth creation, which is that the interest amount gets added to the original principal amount and you have a new base. Your base is not the old base of 1 lakh, it becomes 1 lakh 10,000. So obviously, when an interest of 10% is applied on 1.1 lakh, which is 10% multiplied by 1.1 lakh, you get an interest of 11,000. Now, the third year base is no longer 1 lakh 10,000 because the 11,000 gets added to 1 lakh 10,000, it becomes 1 lakh 21,000. So you can see that your principal reference base for calculating the interest rate is not a static number. It has actually moved up. And therefore, the total interest earned is higher. And if you can see the formula, which is FV equals to PV multiplied by 1 plus R to the power N. I made a statement that earlier N was a very static number. Now it has become to the power N. It's giving you that exponential multiplication effect. And you can see that the formula is 1 lakh multiplied by 1 plus 10% to the power 5, which actually creates 1,61,000 wealth, which means not only we get our 1 lakh rupees back, we have made 61,000 rupees extra wealth. So what does it mean? Compound interest is addition of interest to the principal and plus the interest. So it is interest on interest as it is called. It actually leads to wealth creation in an exponential format rather than linear format over a period of time. Therefore, Albert Einstein actually called compound interest as the eighth wonder of the world. She who understands it earns it. She who doesn't pays it. For example, if we do not understand compound interest, we can get into a debt trap. So let me ask you a question. There are multiple types of loans. Can you tell me which loan is a simple interest, which loan is a compound interest? When it comes to home loan, the EMIs that you pay, the way the interest is calculated, is it a simple interest calculation or a compound interest calculation? So yes, it is a compound interest calculation. If I'm not mistaken, it is a monthly compound interest calculation. How about a credit card? Is it a simple interest calculation or a compound interest calculation? Yes, Tushar, yes, Vivek, it is a compound interest calculation. And if not, I'm not mistaken, it's a daily compound interest calculation. And how about a personal loan? Is it a simple interest calculation or a compound interest calculation? Yes, Vibha, it is a compound interest calculation and it's a monthly compound interest calculation. How about an auto loan? Is it a simple interest calculation or compound interest calculation? So yes, it is a compound interest calculation, a monthly compound interest calculation. So why are we discussing this? Have you noticed all your loans, are all compounded in nature? Daily compounding, like when we have the urge to swipe our credit card, it's great. Swipe your credit card until and unless you're 500% sure that, you can pay the amount fully, completely after that 40 days or 45 days of the free period that you get, the interest-free period that you get. Have you noticed that that's the reason why we end up only paying, paying the interest a lot more and the principal payment happens much lesser? See, the amount we pay back is double the amount that we have borrowed. So try your best to, while home loan gives a lot of tax deductions and benefits, try your best to be prudent. Even those words like 0% rate of interest, please look that is it really 0%? Or even if it has a 1% monthly compounding, that is actually, eating up a lot of your income, and a lot of your income will go towards EMIs. Similarly, let's identify financial instruments. So let me ask you, there are multiple financial instruments available to save, but please let me know whether this financial instrument corresponds to simple interest or whether it corresponds to compound interest. How about a bank fixed deposit, which is a non-cumulative deposit that has a monthly interest payment option? A bank fixed deposit that gives you interest payment on a monthly basis. Is it simple interest or compound interest? So it is simple interest, I agree. It is a simple interest in format. How about a 5-year cumulative bank deposit? It does not give you any monthly or quarterly interest, but it gives you the accumulated amount after 5 years. Is it a simple interest or a compound interest? Yes, Simran. Yes, Vivek, it is a compound interest in nature. Now, why are we discussing this? Your choice of financial instruments can have an impact on your wealth creation ability. So just by changing the option from non-cumulative to cumulative actually leads to the interest on interest phenomena to work, and it creates adequate wealth creation for you. Now you have to look at other investment options. How about a systematic withdrawal plan in a mutual fund scheme where you can withdraw after a certain period of time, but the target scheme from which you are, the destination scheme from which you are withdrawing, maybe is earning returns that's compounded in nature. So always look at the underlying returns that you're earning. If your returns are simple in nature, your returns will be far more blander in nature. How about an equity-linked savings scheme, NELS's mutual fund scheme, which gives you that Section 80C benefit? Do you get a simple rate of return or a compounded rate of return? So yes, Farida, yes, Uma, you get a compounded rate of return when it comes to equity-linked savings scheme. How about a public provident fund? Do you get a simple interest or a compound interest? So Master Trust has also responded. Thank you so much for that. Yes, Anjana, yes, Pragati, yes, Kulbir. It is a compound interest that you receive. Last is debt mutual fund schemes. Does it provide you simple rate or compound rate? So there's no interest provided. The NAV appreciates and you calculate a return, but is that return simple or compounded? So debt mutual fund schemes, I would say that no, it is not simple in nature. I'm afraid it is not simple in nature. It's actually compounded rate of return. So the moral of this exercise is know your products, know the underlying rate of return that it generates. Is it a simple annualized rate of return or a compounded annualized? Compounded annualized, as we saw the case of Warren Buffett, was one of the major tools why he was able to create billions and billions of dollars worth of wealth. So again, looking back at this formula, we may not remember this formula or we may remember this formula, but it is like a Gayatri mantra. It is like a powerful phrase, which is again to reiterate FE equals to PV multiplied by 1 plus R to the power N, where FE stands for what your investment will become in future. PV is how much you're investing now. R is the rate of return and N is how long are you investing. Now, as I've said, we may or may not remember the formula, but there are certain learnings out of it. The learnings is that the more you save makes a massive difference. Your returns, you have to understand that how is it stashing against inflation? Because if change is constant, inflation is going to be a constant monster in our life. Now, if we are saving and our saving is not good enough to battle with inflation, then we have to look at other investment avenues. So the more return you earn makes a difference, but the return has to take in account the risk element also. It should be a valid risk-adjusted return. N stands for, the power of now. You cannot delay. You have to start today. There is no brighter day for tomorrow. The best day is today. The more regularly you invest and the longer you invest makes a massive difference. Say, for example, your dream to become a crorepati can take 53 years at a 8% compounded rate of return. Or it can take just 16 years if you are saving 25,000 rupees. So the choice is yours. If you want to do 1,000 rupees saving for the heck of it, you can still create your first 1 crore, but it might take 53 years. We may or may not be alive. But with just 1/3 of time, we can create wealth, even if our returns may not be 25%, 30%, or 66% like Jim Simons. But we can save. And a lot of that saving, provided that the return is compounded, can help towards getting our first goalpost of 1 crore. So question is, are we just saving in trinklets, or are we saving adequately? Are we saving smartly? That's the question you need to ask yourself. So as I've said, saving is something we might have money issues, but it's the gap between our impulses and our ego. Wealth can only be created by suppressing what we could buy today, because then that money is utilized. It's not that you should be totally stingy. Our culture actually promotes good saving habits. But as I've said, there has to be a balance between splurging and saving. Because the moment you're able to save, you forget about getting control of your money, but you get control over your time. You know that you will decide when to retire, what to do, where to do. You've got enough time, and time is the biggest power, and that's what wealth creation gives. Now I'm showing a picture of Rolls Royce. Now let me ask you a question. Imagine that you've entered a shopping complex and you see this very beautiful looking Rolls Royce cars entering the complex compound, and there comes out a lady out of the car. My question to you is, do you see the lady in admiration, or do you see that car and wish ki I hope I had that car, or one day I will be driving that car? So how many of you look in awe or in admiration to the lady stepping out, the owner of Rolls Royce, or you look at the Rolls Royce itself wishing that you will have this car in future? So Manisha says, I wish I look at the car. And that is the reality of life. The reality of life is that we might have the Gucci's and Louis Vuittons and Salvatore Ferragamos of the world. And we might think that owning all these, a beautiful handbag, a nice stiletto, a wonderful dress, a beautiful stole, etc., we will get the admiration of people. But the reality is that a lot of people are least bothered about what we own, right? Not that you should not spend, but it can be a little bit less flashier, because respect is always earned through kindness, humility, wisdom, etc. So and imagine spending 2 lakh rupees for a Louis Vuitton bag. That's money gone. If you would have invested it elsewhere, it could have grown to a bigger corpus. Again, not to dissuade you not towards investing in all of that. You are the emperor of your life. You can do whatever you want, but think if you're doing it to get social approval, the fact is that actually people don't bother. They don't actually care that how much we own, all of that. They might care, but then predominantly they may not care. And admiration is only earned, by being a slightly better human being. So another important thing that do you know that the printed inflation number that the government agencies publish every month or every quarter is around 6%? That is the inflation the average consumer in India faces. But then that's the overall number. If you have to go granular, if you were to be paying rent rather than receiving rent, the rental yields or the rental amount quantum has risen by 20-25% on an average last year. Medical insurance is no longer the official printed number of 6%. It's around 8%. Similarly, the fuel and power cost has risen by many-fold times. A lot of us, if you are residing in Delhi, you can take a simple petrol price as an example that, today it's hovering around 97 rupees. At one point in time, it was 69-70 rupees. So fuel inflation itself is around 12%. That means, please understand that we are in the context of looking at it from price rise also matters. Rate is just not the investment rate of return. Rate can also be inflation and the way it bloats up the items that you're willing to purchase or invest. Say, for example, a 2 BHK apartment, if the value is 1 crore today at a 6% rate of inflation, it's not going to remain 1 crore. You need to shell out 33 lakhs more. It's going to be 1.33 lakhs. Similarly, if your retirement corpus to retire and happily live a comfortable life in your golden years, if you think it would take a kitty of 1.5 crores at the official printed inflation number, it's actually not going to be 1.5 crores. After 5 years, you may actually have to shell out 50 lakhs more. Now, these are the conservative inflation estimates. Inflation is very product specific, item specific. It also depends upon the city that you reside. For example, the actual rise of real estate might be 8% as against 6%. Or even, as I've said, medical inflation is actually at 8%. It's not at 6%. So if an open heart surgery, say, for example, costs anywhere between 2 to 4 lakhs today, it's actually going to cost much higher. So if your investment is giving you a 5% return or a 6% return, you will be only saving, but you're not investing, your wealth is not growing. So inflation definitely eats away your purchasing power. What is 1 lakh worth of purchasing power to you today? It will depreciate over a period of time, reduce over a period of time, after 5 years to 73,000, after 10 years to 53,000, after 20 years to 29,000, if we have just saved. So saving can be stashing all our money in a locker, or putting all our money into a savings account, or putting into a recurring deposit. But if it's giving you 4% return, you are actually, your money is actually losing its value rather than gaining its value. And let's also appreciate, accept this point that life expectancy of Indian women is moving up. Women live longer than men. Average life expectancy for women in India is around 71 years of age. So imagine retiring at 55, 60, and you have, another 11 to 20 years of life with no stable income. And there is this price rise. So that again drives the point that not only we have to save a lot more, we also have to choose products that could actually should be able to beat inflation or should be able to tackle inflation. So if you are just looking at a fixed deposit that gives you 6% return, believe me, you've not created any additional wealth. But even a 2% difference, I'm not saying that invest into products that give you 15, 20%. Even if an investment is able to give you, or, an allocation of investment is able to give you an 8 to 10% return, you can see that it beats inflation. It actually creates incremental wealth of, 36 lakhs or 43 lakhs over the earlier amount. So we work for a salary or we work for our business. Investing works for us, but investing has to be inflation efficient. So again, a quick trivia. What do you think is the current 5-year fixed deposit rate for State Bank of India for general citizens? It's not to endorse any brand or, berate any brand, but generally, what do you think is the 5-year fixed deposit rate for a general for general citizens? 5.2%. Well, it is somewhere around 6.5%. Now, what is the current interest rate of Public Provident Fund? Okay, 7.5%. Well, it is somewhere around 7.1%. But my question is, are these investment options enough? Public Provident Fund could be an exempt product. So you make the entire 7.1% as your return, but then it has a limit. You can invest up to 1.5 lakhs, etc. But in a State Bank of India fixed deposit, if you are at the highest tax rate, then your post-tax return will actually work out to be 4.4, 4.2%, and inflation is on the higher side. So we need definitely equity. There are notions, it is volatile. There is a risk of losing capital. Our grandparents never invested. We have to take a bit of risk, because you have to choose products that can actually give you a slightly better returns than beating inflation.
So, Amrita, quick question again from me, and I'm sure a lot of people in the audience want to, discuss this. What is the best way to assess your risk appetite, and how do you gauge if equity is the way to go, or what kind of mutual funds you should be investing in?
So that's a great question, Palka, that risk appetite is a function of risk tolerance and risk capacity. So if you're very knowledgeable, then there is you can take exposure towards equity, a slightly higher exposure towards equity. But then if you have a lot of wealth that actually supports that, your savings, the steadiness of your job, your skills, etc., actually helps you to take higher exposure towards equity. But having said that, people can be wealthy, but yet their perspective towards taking risk to equity can differ. So you have to ask yourself that if markets have to correct by 30% tomorrow, and if my 1 crore investment actually comes down to 70 lakhs, what am I going to do? Am I going to redeem? Am I going to switch out? Am I going to look at it as an opportunity and invest a lot more? Because it's quite, as I've said, psychological in nature. And no matter how much wealth we have, our attitude towards risk is what determines your risk appetite. So there are these thumb rules like 100 minus age, which is if your age is 30 and take 100 as the benchmark number, 100 minus 30, 70% should be towards equity. But I don't think those are very evolved rules of allocating. Risk appetite is a combination of your capacity, your financial capacity to take risk, as much as it is a combination of your psychological ability to take risk. If you do not have the great psychological ability to take risk, then the equity exposure should be higher, and vice versa, the equity exposure can be lower, and vice versa, equity exposure can be higher.
Thanks, Amrita. Thank you.
Sure. So, as I've said that, we have seen almost 11% compounded return I've taken period of 2013 to 2023. There have been a lot of events, be it policy paralysis, taper tantrums, demonetization. 5 out of those 7 reasons which impacted Indian equity markets were reasons that did not stem out of India. They were actually global reasons and global factors. But stock markets moved up. So it ebbs and flows like an ocean. It has its crest. It has its trough. It will again have its crest. It's like a sine waves of physics, with the difference that the center line, unlike in physics, which is inclined at 0 degree, here the center line is inclined longer. So it will have its ups and downs, the crests and the troughs, but over the long period of time, it is definitely compoundingly rewarding. So as I've said that by nature, we are impulsive, we jump to conclusions, etc. Look at COVID, there were aspersions and apprehensions casted that, the world is coming to an end, vaccine creation might take 10 years, etc. Human beings are the next dinosaurs. But by 2021, markets had recovered and human beings were considered to be invincible. So if we are not having our investments linked to goals, our thoughts will waver here and there. That therefore investments should be linked to goals and we should invest regularly. So are you mindfully saving? Are you mindlessly saving? The choice is yours. We have to link our investments to goals. We have to take into consideration the impact of inflation. So very important that you should have the right investment options. Therefore, I would say that every asset class has its positives, negatives. Say, for example, equity has the propensity to create wealth. It is volatile. Fixed deposits and debt asset class can, give you regularity of income, but then it may not beat inflation. So the apt way is to asset allocate, and asset allocation, as Palka had mentioned a wonderful point, should be linked to your financial goals. It should be linked to your time frame. It should be linked to your risk appetite. If you are saving for a goal that will materialize within 3 years, equity is not the right asset class for you. But if you are looking at certain expenses and events that will occur after 7 years, then basis your risk appetite, a higher proportion can be looked into equity. So end of the day, asset allocation is that it wants to manage your risk, but it also wants to give you a returns that is quite inflation competent.
Again, a quick interruption. I see
Yeah.
precious metals, and Indian women especially love to invest in physical gold. So, what would you have? What would you advise them? Is investing in physical gold very different from gold ETFs? How are the returns like, and what is a better investment option?
I think that's a fantastic and a very contextual question, Palka, that you have asked. See, physical gold has storage issues. If you're buying physical gold, be it in the format of a gold bar or a gold jewelry, we all know there is wastage and making charge involved. So gold ETF is nothing but an electronic version of gold, and per unit represents, 1 gram of gold of the purest quality. You are actually holding a financialized version of gold by virtue of having a demat account. The prices are very transparent, and in terms of returns, gold is actually considered to be a hedge against macroeconomic uncertainty, and it's considered to be a hedge against inflation. So if you look at the last 5 years gold returns, gold as an asset class in terms of price is also volatile, but it is less volatile compared to equity and more volatile compared to fixed income or debt as an asset class. But in terms of returns, if we call it as a hedge against inflation, if inflation has been around 6.5%, gold returns has been around 11%. So instead of buying physical gold where you may not be able to liquidate it on time, this is a much better format of buying it, far more transparent, far more redeemable, and you can actually ascertain its value, and therefore far more convenient.
Perfect. Very informative. Thank you.
Sure. So, as I've said, I think this is a great point, is that imagine Akanksha and Isha. Both are of the same age. Akanksha starts investing now. Isha says ki abhi to main jawan hu, I'm going to enjoy my life, and she procrastinates saving decision, and she starts saving after 10 years, and she invests double the amount. So even if Isha has invested double the amount every month, and both Akanksha and Isha have earned the same compounded rate of return, and Isha ends up saving a lot more, you are surprised that Akanksha actually created a lot of wealth. She created a lot of wealth. Any reason why? How is it possible that Isha has invested double the amount? She has saved a lot more. But how is it that the wealth creation has favored Akanksha? What could be the reasons? Yes, Richa, she has started early. As simple as that, the Warren Buffett example. Akanksha invested for 35 years. That extra 10 years actually made a lot of difference. It led to better compounding effect. So the power is today, the power is now. You have a cost if we delay investing action. Similarly, we have an urge to, break our EPF investments. And by the way, even EPF is compounded in nature. The return that we get, we try to break our EPF coppers, put it for a down payment to a house, which I don't think is a great investment choice. If you keep your investments intact or link it to a goal, your goal can fructify, concretize after 5 years, 10 years, 15 years. You can see that the longer you stay invested, the kind of wealth it creates, the choice is yours. You want your 10 lakhs to transform into 60, 70 lakhs or 1 crore. The choice is yours. And sometimes the long term matters. So there was this friend of mine who worked in a bank, and one of her investors actually invested a lot of money. Her 10 lakhs had actually grown to a big chunk of amount after 10 years. And the investor was very happy with her. You did a fabulous job. You made my wealth grow by 7-8 times. That's phenomenal. And though my friend humbly accepted all the compliments, she later on told me that, Amrita, I have nothing to do with her wealth creation. I may have suggested her the fund, but the fund that I suggested was not the top performing fund. The reason why she did so well is that she frequently traveled abroad. She forgot to check her investments regularly because she forgot that she has such an investment and she didn't tamper with it. The reason that she gave so much of time actually led to wealth creation. So sometimes we need to have a bit of a, amnesia effect. We need to forget. Not that you should forget it fully. Give your entrust your money to able advisors like mastertrust so that they can conduct those periodic reviews. But staying for the long term definitely helps. So we have mentioned all these points. I may not want to repeat it, but please invest systematically. If you're getting into a recurring deposit also, if you're not able to generate returns that's beating inflation, if you're not able to generate returns that's compounded in nature, you're putting a lot of effort, but the outcome is not more. But you should invest regularly because small drops of small drops of water makes a mighty ocean. Systematic investing, especially an option given in mutual funds, is a good one because you can start with as little as 500 rupees per month. You would not even imagine that, going to a restaurant or going to a nice mall, we end up splurging 5,000-6,000 rupees. But a small little investment can create a big big chunk of money for you in the future. It harnesses something called averaging principle. It's called the rupee cost averaging. And how it works is that imagine you're investing 10,000 rupees a month. At a higher NAV, you're getting lower units, but at a lower NAV, and NAV is the price of the mutual fund unit, you actually end up accumulating higher units, which is 10,000 divided by 8 rupees of NAV, gives you far higher units than 10,000 invested at a 10 rupees NAV. So what happens is that you would have invested 40,000, you would have accumulated 4,190 worth of units, and you can see that your average cost of unit comes down and there is a wealth creation. So SIPs also can give you negative returns in 3 years, 5 years, etc. But then the degree of negativity might be lesser. But if you continue to do that SIP, and considering the question that Palka has asked, a lot of my wealth creation and journey started not by investing big chunks of amounts, but actually doing all these periodic investments in the format of systematic investment plans. So it leads to lower cost of unit and better wealth creation. So quickly, I will also just, cover certain points, which is, in terms of what kind of products you can look at. So I'll just quickly share my screen. Please let me know if it is visible. So there are a plethora of investment products there. You've got the PPF, NSE, tax saving FDs, debt hybrid funds, equity linked savings products, equity mutual funds, NPS, RBI bonds, EPF. There are a lot of things. Though it is all mentioned in the screen, can you tell me which are the instruments that give you Section 80C benefit? So Section 80C benefit is that it gives you a deduction of 1,50,000 rupees in the old tax regime, where that amount can be deducted from your income. And obviously it helps you save taxes. So which are the instruments here that give you the benefit of Section 80C? Yes, it is ELSs, Rahul. Yes, it is ELSs. Yes, Richa. PPF, tax saving FDs, ELSs, even NPS gives you Section 80C. It also gives you additional 50,000 tax deduction benefit under Section 80 CCD 1B. Even your EPF gives you Section 80C benefit. So wherever you can get those tax benefits, tax optimization, you should look at it. Tell me one thing, which are the instruments where the interest that you receive is fully taxable? So you're getting an interest and it is fully taxable. Which are the instruments where the interests are fully taxable? Instruments that are fully taxable.
Tax saving FDs?
Yes, it is tax saving FDs. Yes, even RBI bonds. Why am I putting this point? Even EPF, which is a very famous, choice of investing for your retirement kitty, you can see that interest is tax-free up to contribution of 2.5 lakhs. This came in, I think, a year before or, a union budget announcement. That contribution beyond 2.5 lakhs, it is actually, interest is actually taxable. So why am I explaining all these points is that your investment has to not only should have tax deduction benefits, it should be tax efficient. And what I mean by tax efficiency is that if we look at, say debt, equity or debt mutual fund schemes, the incidence of taxation arises when you're redeeming. Now your FD can mature and it gets rolled over. But then at maturity, you are facing a tax incidence. Here in open-ended debt mutual fund schemes or, open-ended equity mutual fund schemes, the tax incidence arises when you are actually redeeming. Otherwise, the tax incidence is not arising. It can arise if you have opted for a dividend income. And if you're getting dividend, then it is taxed at the highest rate of taxation. Whatever is your marginal rate of taxation, it is charged at that. But you should know the tax structures. In fact, if you're making a gain within a year in equity, it is called a short-term capital gain, and we pay a 15% tax plus cess and etc. If our time horizon for gains is more than 1 year, we've received a gain for more than 1 year. Gains up to 1 lakh is exempted from any capital gain tax, but beyond gains beyond 1 lakh, there is a 10% tax. When it comes to debt mutual fund schemes, gains for a time period of less than 3 years is short-term capital gains, and it's taxed as per your tax slab. However, gains beyond 3 years, there is a 20% with indexation. Now, the word is indexation. What is indexation? Is that imagine you've invested 10 lakhs into a FD, 10 lakhs into a debt mutual fund. You're getting the same rate of interest. The value is also the same after 5 years. But there is something called cost of inflation indexing, which means you can inflate your principal amount in a debt mutual fund scheme. That means what you have to do is 10 lakhs multiplied by what was the inflation index in the year you were redeeming, what was the inflation index in the year you have purchased. So in this case, the year when you were redeeming, the inflation index was 331. The year when you had invested, the inflation index was 280. So 10 lakhs multiplied by 331 by 280. Your principal amount is no longer 10 lakhs. It's got inflated to 11.82 lakhs. So when you are subtracting and finding out what is my gain, what is my net gain, it's not a simple 14 lakhs minus 10 lakhs formula. It is 14 lakhs minus 11.82 lakhs. You are showing a lower gain. A lower gain with a 20% tax is a 44,000 rupees tax. So you are actually making a net of tax better investment value compared to a fixed deposit. So all these matters, but having said that, debt mutual funds, you have to look at what's the type of a fund, because there could be credit risk, there could be interest rate risk, there could be liquidity risk. And it's always better to trust somebody like a master trust to help you take those prudent decisions. So my only contention is that, why am I discussing all this, is that please make an objective evaluation, have a trusted financial advisor, look at rates in conjunction with the ability to give compounded returns, tax benefits, and all those matters, because you want to make a return which is inflation efficient and tax efficient. One final point before we call it a wrap. Do you think it is investment or insurance, or do you think it is investment and insurance? Do you think you only require investments, you should not look at insurance, or you require an amalgamation of both investments and insurance? Both? Yes, absolutely. I agree, you require both. So I would rest my case saying that insurance is meant to provide protection to a family when we are no more. Investments are meant to provide us a safety net when we live longer. So it's not an India versus Pakistan issue. It is that we need both the products. You have to ensure your health, even if you have a medical insurance plan by your company. Is it enough? Can there be unforeseen expenses when it comes to hospitalization? So please ensure your health insurance is adequate. Do you have a term insurance? Can you take critical illness riders? And they all come with those Section 80D benefit also. And, and these are the slabs, like if you're taking a health insurance for yourself, and if you're less than 60 and your parents are also less than 60, you can claim 50,000 deduction. And if both yourself and your parents are above 60 years of age, you can take, you can get a 1 lakh deduction. So all that matters, tax deduction. It's not, insurance is something which is meant to protect your family members when you are no more, meant to give you liquidity if our health goes for a toss. So both are important, and therefore you should look at a trusted financial advisor to guide you. To end, women in India has always been resilient. It's not just the kings. We have had queens who could brandish a sword and fight against, the enemy. You had queen who could, like Ahilyabai Holkar, who led the city of Indore. The first female judge in India was Justice Anna Chandy. It's just names. We have entrepreneurs, presidents, athletes, political leaders. Women in India have always been, they are epitome of dignity, of resilience, of power. So as I've said earlier, and there were some fantastic questions that was asked by Palka, is that women are now the breadwinners. There could be pay parity, there could be unconscious bias that we might face, etc. But we are very gritty. We are quite, we have good willpower. It shows in our savings habits. We are better investors. These surveys have repeatedly shown that retirement, buying a home, educating our child are the key financial goals of investors. We have been prudent risk takers. We invest for the long haul. Research by Warwick School of Business, University of California, Berkeley, Wells Fargo has indicated that women actually earn at least 1 to 1.2 or 1.3% higher returns than men. 1 in 4 investors in India are women. So the statistics have also improved, but my question is, why is the median age 33? It has to, we have to start early. We have to, start taking charge of our finances.
Absolutely, Amrita. This is amazing. And yes, we have to make our women, our girls more financially literate so that they can manage their money. And it's not rocket science. All the pointers that you've explained today are so simple and, so basic, come to think of it. We just, in the financial industry, also have this habit of throwing out financial jargons. So people, feel that financial management, money management is, so complex, when you just need about 3-4 pillars to work on and you are sorted. So just one quick question, and we've been having a lot of questions in the chat box.
Absolutely.
I'm not sure if we have the time to, take up all of them. So I will just pick a few which caught my eye. And one of that was by Richa. Apart from FD, where do you think can we keep the emergency fund?
I think that's a pretty valid question. So while you have got liquid funds, like in the realm of mutual fund space, we have these short duration products. Liquid funds actually invest into debentures and bonds and bills that mature within 7 days to 1 month. So there are products like liquid funds, ultra short duration funds, overnight funds, which from the mutual fund space you could look at, and they are apt products for building your emergency corpus.
Perfect. Then there was Simran, who said that my mom is a single parent and I want to save and invest my money, which can be helpful for her future. So a very noble thought. What fruitful investments can I make for this purpose?
So, if she is, if a mother, or if she is making investments for her mother, considering her age, etc., I would suggest, it should be either a portfolio allocation towards equity and debt, and a bit of cash. She could also look at hybrid product offerings from the mutual fund space. We have all these, hybrid funds, etc., which has a certain proportion towards equity, fixed income. There are products like balanced advantage funds, where the portfolio manager bases certain rules and bases certain parameters, would asset allocate between multiple asset classes. So for her, it should be asset allocated oriented portfolio construction, or there are these auto asset allocated products in the format of hybrid funds and balanced advantage funds.
Okay, I hope that was helpful for you, Simran. There's another question that has just come in, which talks about how can women start investing for a solid financial future. Pragati has just asked this. How to make a start?
So the start is today. Like, my only regret is, why not 2002, when I started earning money, right? And there were these lot of things going in my mind. Oh, I was a management trainee at that point in time, not the head of learning and development. So I wanted to solidify my career, create an impact, etc. So I was procrastinating the decision of investing and saving wisely. But my only regret is, why didn't I start in 2002? Why did I start it in 2008? So there is no, when to start is the power of today. There could be a lot of apprehensions in our mind, but we have to make a start somewhere. And the rule of thumb is, please save at least 20% of your salary. It won't hurt us much.
Okay, one last question, which says, should we be versatile while planning for investments? I assume she means should we diversify while planning for investments?
So absolutely. In fact, if you look at even studies that have indicated, be it studies concerning, which are the securities in an index that has created the wealth for that particular equity index, it seems that be it Dow Jones or be it Sensex, is only 7 or 10% of stocks that actually create maximum wealth for that particular index. So diversification is a strategy of, it's a strategy of not making a killing of returns. It's a strategy of not getting killed. So there would be some investments that will not fire. There will be some investments that will actually do well. Net overall, they balance each other out, and they give you a return that actually is far more, inflation efficient and tax efficient. But having said that, versatility, you should review your portfolio. But as I've said, human beings are such that our mind wavers. We can be prone to herd mentality. We can be prone to very impulsive thinking. So guided portfolio review with the help of a proficient financial advisor is the way towards versatility.
Perfect. And it makes a lot of sense. And there are financial advisors and financial planners who are available there just to help you make perfect portfolios and just to educate you wherever you are stuck. They're there to help you. So thanks for that, Amrita. We still have a lot of questions. I'm not sure if we'll be able to cover them today, but it'll be amazing if you can just email your questions, which you feel that you need more answers to, webinar@mastertrust.co.in, and we will try and send you as many answers as we can. And thank you so much to the audience. We had a large number joining in today, and they have stuck with us for last 90 minutes, Amrita. So kudos to you. You were able to get that interest in there, and a lot of people, I'm sure, have got amazing pointers, a lot of food for thought that they are taking home from this webinar. Thanks a lot. Thank you very much, Amrita, for such a wonderful and informative session. It was simple and complex subjects answered with such simplicity. And as I mentioned, we financial industry are to be blamed a little bit for throwing all those financial jargons and making those things too complex, which are rather simple in nature. It can be as simple as just concentrating on emergency fund, compounding interest, asset allocation, and goal planning. And thank you so much for sharing your personal financial experiences. I'm sure a lot of people in the audience, and even I could relate to, and I'm taking a lot of food for thought back home. I truly believe that as a woman, you should be able to independently manage and take care of your finances to fulfill your aspirations, your goals, your dreams, and your wishes. And for that, you have to make your money work for you. Well, this concludes our session. Thank you, everyone, for being a part of such an amazing discussion and being so engaging. We have a lot of people's names and email IDs that we will be sending the soft copy of Psychology of Money to tonight. So I hope we all have learned today and our perspectives have broadened. Women must take the lead. And with that, thank you so much for joining in. That's it for tonight. Hopefully, we will get you more webinars like this in the short future that I foresee. Thank you so much, Amrita, once again. Thanks, audience, for joining in.